journal and ledger.
Yes, as I already mentioned in the very beginning that today Study Creatively has for our fellow friends the topic journal and ledger to understand.
So friends, today I'm going to teach you what is journal and what is ledger. So before understanding what is ledger and journal, we need to understand what is account. An account is a summarized record of transactions of a particular head at one place. So this was about account. Let's understand what do we mean by journal and ledger. Hey, let's understand what do we mean by journal. Journal is a book of original entry wherein transactions are first recorded. Ledger is called the principal book of account as all the accounting information can be collected from this book. Since journal is a book to record transactions first and thereafter transferring or posting the entries into ledger accounts. So my friend already told you and introduced with you the journal and ledger meaning. Now I am going to tell you what are the characteristics of a journal. So journal is a record of transaction in a chronological order. Chronological means line by line, step by step. Second characteristic of journal is it is a book of original entry in which transactions are first recorded and therefore transferred into the ledger. Third characteristic is that it records both debit and credit aspects of a transaction by using double entry and bookkeeping. So steps in journalizing or rules of journalizing. Here we see the three steps which are involved in journalizing any entry. So the step 1 is determine the accounts that are affected by a transaction. So step 2 is determine nature of the affected account is that whether the accounts involved are personal, real or nominal as per traditional approach, asset, capital, liability, expense or revenue accounts as per modern approach. So you have to determine the nature of the affected account. That is a step 2. Now moving on to the step 3 is, and the step 3 is to determine the accounts to be debited and credited by applying the rules of debit and credit. So first let's understand how do we determine the accounts to be debited and credited, or is going to be what are the rules of debit and credit. So, traditional approach of classification of account involves personal, real and nominal or revenue or expenses nature of accounts. Okay, so first let's understand what are personal accounts. Personal accounts, accounts of individual firms, companies, entities, etc. Personal accounts, examples of personal accounts are accounts of Ram and Company, a customer debtor, Javeri and Company, a supplier of goods creditor, and then the rule for personal accounts is debit the receiver and credit the giver. Real accounts are the accounts which relate to tangible or intangible assets of the firm. Example of tangible asset are land, building, investment, plant and machinery, stock, cash in hand, etc. Example of intangible asset are goodwill, patent, trademark, etc. Rules of debit and credit applicable on real account is debit what comes in, credit what goes out. Revenue account, accounts which determine profit or loss, we say they are revenue or expenses account as well. So accounts of expenses, losses, gains, revenue, etc. are nominal accounts, and stating differently, accounts which determine profit or loss are nominal accounts. Examples are salary account, purchases account, interest and paid account, sales account, commission received account. The net results of nominal account is profit or loss which is transferred to the capital account. Rule of debit and credit applicable in nominal account is debit all expenses and losses, credit all incomes and gains. So till now we have talked about the traditional approach of classification of accounts, and as far as modern approach of classification of account is concerned, we can classify accounts into 5 categories: asset account, liability account, capital account, revenue account and expenses account. Okay. So here my friend is going to explain you the rules of debit and credit according to the modern approach of accounting. So I'm going to tell you rules of debit and credit. Asset is equals to liabilities plus capital plus revenue, that is income minus expenses or losses. Do remember guys that asset always have debit balances, and when they increases they again are going to get debited, and when the asset decreases we are going to credit the account. As far as liabilities are concerned, liabilities always have credit balances.